Welcome to the latest episode of our podcast series for financial advisors. Today's episode is, If You Build It, Will They Buy It? It's a special industry update on M&A with Jason Diamond. I'm Mindy Diamond, and this is the Diamond Podcast for financial advisors. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more. Mergers and acquisitions in the wealth management industry continue to break records and dominate the headlines, particularly those at the enterprise level, like LPL's acquisition of Commonwealth. And while that transaction rocked the world at Commonwealth, there are plenty of advisors who have a more personal interest in the prospect of M&A. That is, they're thinking more about their own business and maximizing enterprise value so that one day they can sell it on the open market. The concept of M&A is one that we're often asked about, especially by advisors who work in the wirehouses or traditional space or are building practices at other employee model firms. They're often attracted to the potential of building an independent business that they can monetize at the end of the day, but are unclear on what it takes to get from A to B and beyond. And even more importantly, they're wondering, if I build it, will they buy it? So I asked my partner, Jason, to join me on this episode to answer that question by exploring the prospect of independence, the opportunities that exist in the current industry landscape, maximizing enterprise value, the potential buyers, and much more. There's a lot to discuss, so let's get to it. Jason, let me welcome you today.
Thank you. Thank you so much for having me on. I'm thrilled to be here.
Great. All right, so let's jump into this heady topic. Why does M&A matter? Like, who really cares, especially if you're currently an advisor at a traditional firm?
Yeah, it's a really good, fair question. I think there's this perception that as long as my firm doesn't get bought, who really cares? I'm insulated. Or said another way, M&A is this nebulous concept that happens at the enterprise level for a lot of advisors. So to use a recent example, LPL's recent purchase or announced purchase of Commonwealth really rocked the industry in the independent space. But if you were an advisor at, say, Merrill or Morgan, it's possible you weren't even aware of that, which is funny if you speak to an LPL or a Commonwealth advisor. That's the only thing they've been speaking about now for the past 2 weeks. But those enterprise level M&A transactions, while they're certainly important, it muddies another important point, which is that individual advisors who control books of business, so productive advisors, also control an asset that they have the ability to monetize for a very significant sum of money at day's end. So just like Commonwealth is able to sell to LPL, many individual sole practitioner or team advisors build businesses either for the purpose of or with the intention of selling it down the road. And that's, I think, more what we want to focus on today is this idea that advisors, even wirehouse advisors, have as an option the ability to launch, own, operate, and ultimately sell an independent business.
Great points, but let me unpack that with you a little. So number one, if you work at a traditional firm, most firms, certainly the wirehouses, have sunset plans, retire in place programs. So why does the concept of M&A matter to them?
That's a very fair reaction, and that's probably the reaction we hear more often than not from a wirehouse advisor. So what Mindy's alluding to is the wirehouses have created, and honestly, it's not just the wires anymore. It's really every traditional firm, programs that allow Gen 1 advisors to retire in place without the need for a transition. And the bonus is they get to monetize their life's work without having to make a move. The next gen effectively inherits the book, and the firm basically finances the transition from Gen 1 to Gen 2. And there's absolutely nothing wrong with that approach. These sunset programs, I think, are a real gift to both Gen 1 and Gen 2 advisors. But I'll give you two important caveats. Number one, they tie the next gen to the firm, and not everybody, both Gen 1 and Gen 2, is comfortable with that prospect. And then number two, probably more to the point of this episode, those transactions or transitions are often consummated at a discount to fair market value because they're internal succession programs. So I think it's important for advisors to understand what are my options, which includes signing. And in fact, maybe that's even the status quo or the bar against which advisors measure is the idea that if I do nothing, I can always sign my firm sunset program. But I think it's important for advisors to measure that against many different things, one of which would be moving the book to another W-2 firm and getting a recruiting deal and then entering that firm's sunset program. But certainly another flavor of that would be what we're talking about here, which is launching an independent business and then ultimately monetizing it at day's end, which is a very compelling alternative, certainly economically, to the retire in place deals because they're more lucrative and they're done at capital gains as opposed to ordinary income.
Yeah, I agree with that 100%. And I think it's also important to note that not everybody has the desire to be independent. So what we're going to focus on today is the notion of M&A if you build an independent firm. The notion that an advisor is sitting at a traditional firm and evaluates lots of different options, and one of which is to go independent. And one of the motivations for going independent is to build an enterprise that they can ultimately sell at day's end. But let me ask you a question. What of the advisor, and even though this is not necessarily the topic for today's episode, but it's a fair question. So, what if the advisor that says, yeah, I recognize that if I sign my firm's retire in place program, I'm tying myself to the firm, I'm limiting my options, I'm limiting Gen 2, I'm selling my business at a discount. What other options are there besides going independent?
Yeah. So, first of all, even having said all of those caveats you just mentioned, those retire in place programs are still a very compelling proposition. For most advisors, they'll at least consider it because it's absolutely the easy button. Certainly, the whole ecosystem of independence, which requires an element of entrepreneurial spirit and the ability or the appetite. Said another way, you have to want it, right? Being an independent business owner, even though it presents tremendous lucrative opportunities down the line, as you're alluding to, not everybody wants that. So, what else can an advisor do? One is, as I said, the sunset programs, but the other flavor of this is there are plenty of firms that allow you as an advisor to transition your book of business and get paid a very meaningful sum to do so. And then the good news is that those firms also offer sunset programs at day's end. So two compelling alternatives have emerged for particularly wirehouse advisors who say independence is a bridge too far. One is the regional firms. So firms like RBC and Raymond James have really moved up market and made themselves much more sophisticated, viable players for top of the food chain talent. And then the other bucket that I'd be remiss if I didn't mention, especially for top of the food chain advisors, is boutique firms like Rockefeller. I can't tell you how often we see advisors who are interested in independence, but ultimately pivot back to one of those other models because independence just feels like a bridge too far. So maybe I'll turn that question to you. In speaking with some of the biggest advisors in the industry, how often do they want to hear about independence and how often do they ultimately end up there, in your opinion?
Yeah, I love that question because there isn't a conversation that I've had in the last decade with a top advisor. And I'm talking advisors that are generating 10 million, 5 million in production, managing a billion or more in assets that don't want to at least understand what it means to be independent and what their business could be worth as an independent. Why? Because as we're going to talk about as we get through this episode, because those businesses are just the valuation. If you're looking to maximize enterprise value, the valuation of an independent business is where you get the max. And so everybody wants to understand it. But yet, at the end of the day, many of those advisors look at independence, despite how appealing it is to be able to maximize the value of your business, and say, as you said, it's just a bridge or 5 bridges too far. It's just not what I want to do. So, we are not in any way pitching this episode as you have to go independent, because many people are comfortable sacrificing some basis points on the value of their business in order to live a business life that's more soulful. But what we're going to pivot to now is talking more about those who do go independent. How do they maximize the value of the business? So let me ask you a follow-up question to that. If an advisor is interested in independence, why do they need to understand M&A and business valuations in order to properly or fully evaluate the independent space?
Yeah, so that to me is the $1,000,000 question, if you'll excuse the slight pun. Here's why. I guess the short answer is an advisor does not need to understand it, right? We've worked with plenty of advisors who decide they're going to launch an independent business for reasons that are completely separate and apart from anything touching economics. That's a pretty common approach, especially for smaller advisors who say, I'm just fed up at XYZ firm. And while the economics and the idea of owning the business and owning the client data and having autonomy is nice, I'm really making this move because independence is what it sounds like. And I want greater freedom, flexibility, and control to service my clients, to run my business, to grow my business, etc. So it is entirely possible that an advisor says, the M&A concept makes sense to me. I get it as a whole, but it's just not that important to me. And I'm not even going to think about it right now. When we speak with advisors, we tell them that we think that's a little bit of a mistake. And again, it's not because everybody's going to build this business and sell it tomorrow. And some people will ultimately never sell, right? They'll pass it down from one generation to the next. But here's why it matters. Here's why I think advisors need to understand this concept. Because when you think about the economics of independence without the concept of M&A, it just doesn't make a whole lot of sense. And I'll give you an example of what I mean by that. Let's take a hypothetical $5 million wirehouse advisor, right? I've got a $5 million advisor at Merrill, corner office type guy, sophisticated, largely fee-based, clean book of business. And this advisor has plenty of options. As we've mentioned, option one is they take the firm's retire in place program. And those programs pay, for my $5 million hypothetical advisor, probably somewhere between 150 and 200% of revenue. So that's option one. But option two is they could decide to move their book of business to another traditional firm. And in doing so, they'd get certainly north of 300% of revenue, and then the ability to enter into a retire in place program at that firm. So you're talking about all in easily north of 450% when you combine the transition deal and the retire in place deal. Now, I say all of that because if you think about a move to independence, it comes with none of that. It may come with some modest transition capital. So the independent broker dealers maybe pay 50 to 75% of revenue in transition dollars. And the ongoing payout is certainly going to be better because you own the business. So instead of netting out at, call it 45% at the wirehouse, maybe you're more like 60 or 65% in independence. But that ongoing payout differential and the modest upfront are not nearly commensurate with or enough to overcome those really strong economics that we just laid out in the traditional firm world. So what that means is if you really want to make the economics, the math of independence make sense, if you want it to be able to stack up well against these W-2 options, you need to understand this M&A concept because that's where the lion's share of the value in the business lies. It's not in an upfront recruiting deal. It's maybe a little bit an ongoing payout, but it's mostly in the ability to sell the business at day's end.
Yes. And I think that's actually the absolute right thing to say. And you're right that there are plenty of people that say, I want to build a business. I want to build a legacy. I want to pass it on to my son. I want to pass it on to the next generation. All good. But even to create a business or build a business that you're able to pass on to the next generation, even if you do so at a discount, that's still an M&A transaction, and it needs to be part of the equation when you talk about the whole value of the business or why people go independent. And to be honest with you, if you think about the hundreds of advisors that we have been privileged enough to interview just on this podcast, that's what they all talk about. They're building a business. that feels soulful, that feels right, that allows them to customize what they're able to do for clients, to be a buy side advocate for clients, for all the reasons we've talked about ad nauseum on this podcast. But not a single one of them fails to address the notion of the end game and why they're doing it. So let me ask you another question. Let's talk about why it matters. I want to understand who the players are, like who are the buyers and who are the sellers. But before we do, we talk about how you can't talk about the benefits of independence without thinking about the valuation or the notion of M&A at day's end. How many years do you have to wait in order for that to make sense, or as you say, stack up against what you're passing up?
So not as many as, and we'll talk about the players in a second, but let's take that second question first about how long somebody has to wait to kind of realize the benefits of this. It's not as long or cumbersome process as some people are led to believe. One of the things we talk to advisors about all the time is this notion that private equity firms and other interested buyers, who we'll go through in just a minute, are trying to figure out a way to even shorten that timeline even more by recruiting or acquiring businesses directly from the wirehouse world. So meaning you take a firm like a KKR, some of the biggest private equity firms in the world, our view is they will ultimately crack the code and figure out a way to essentially buy a book of business right from a wirehouse without the middle step of setting up an independent business. But in today's ecosystem, there aren't that many compelling options that solve for that. In order to maximize the value of the business, you really need that interim step of first launching the independent business and then selling it. So the question is, how long does that take? Here's how I'd answer you. I would say from start to finish. So you're my $5 million hypothetical Merrill advisor. From day one, when you start conducting due diligence, you're probably talking about somewhere between 4 to 9 months of due diligence to ultimately launch your independent business. And that's figuring out, do I launch my business under a broker dealer umbrella? Do I use a support partner or a platform? Do I launch my own RIA? And then ultimately doing it. So that's step one, is get the independent business off the ground. Step two is establish a basis. So once you've launched the business, most buyers are looking for 365 or 366 days of basis so that the transaction can be done at capital gains. And then the only other piece of the equation as far as timing is really, how long do you think you need to wait so that your clients are sticky to a potential buyer, right? So you have to be mindful of the fact that you've just now asked your clients to leave Merrill to join you in this independent business. And then if you're going to sell, you need to make sure that they're going to stick around because of how the transaction will ultimately be structured. So there's no reason this whole exercise can't be done in 2 years. I'd say the average we see is probably more like 3 to 5 years. Does that address your question?
Yeah, I think that's and I was going to say that. And even 3 years feels a little short, not because it can't be done and not because it hasn't been done. But I was going to say 5 years is
Yep.
probably the amount of time. And so it begs the question, or as a follow up to that, is so what if an advisor, a G1 advisor, that says, I've got, say, a 5 to 7 year runway before I retire? So the notion of independence means you're asking me, or my next generation is asking me to eschew a big upfront check to take significant chips off the table up front, to pass up the ease of going from one traditional firm to the other in order to wait a long time. And if I've only got a 5 to 7 year runway, does it still work?
Well, it's a really fair question. And these are instances when something has to give. And a lot of times, what that means is if the Gen 1 advisor is that adamant or averse to the risk or wants to put liquidity in their pocket or more of the bird in the hand, this is the team that you're describing that might need to make two moves. They may need to move to a traditional firm now to solve for the retiring advisor's need or want to monetize. And then they will wait until the forgivable loan or recruiting deal vests and then move again to solve for the Gen 2's desire for independence. That's one possible path. The other possible path is that the Gen 1, the retiring advisor, is the one who's flexible and says, this may not be my first choice or my preference, but I'm comfortable because my next gen is important to me and this is really what they want. And they will find a way, because that's the beauty of a move to independence, is there are so many different ways to skin the cat of paying or monetizing Gen 1, whether it's from the cash flows of the business, selling an equity piece, a debt solution, that's the other option here, is that Gen 1 decides they'll be flexible with their glide path. But let me ask you, how often do you see it where the Gen 1 advisor says that? They say, we'll move to independence. I've got 3 to 5 years left in me. But then they just get totally re energized or rejuvenated by the move and end up staying on. Does that happen in your experience?
Yes, and more often than you think. But the caveat is that independence allows that Gen 1 advisor to the flexibility to figure out what role they want to play. So there is not a one prescribed or one size fits all way for that G1 advisor to continue in the business. They may become chairman emeritus, they may just do business development, they may work part time. The problem with a lot of the retire in place programs is that there are real prescriptions, tremendous lack of flexibility of what the senior advisor can do once they sign those programs. So it's not just about being re-energized, but it's having the flexibility to work the way you want to long past the end of your deal.
That's a very smart point. So I do want to address now the buyers and sellers concept. Let's start with the sellers because this is what we've been talking about. Again, to back up the train here a little bit, I think we've got two broad types of sellers. We have firms that are selling, and one area that I do want to highlight, this is only tangential to the focus of this episode, but we expect to see more of this broker dealer consolidation at the enterprise level. So we don't view this LPL acquisition of Commonwealth as an isolated event. I think we're going to see more, particularly smaller enterprise type firms, broker dealers, be purchased in the months or years ahead. But more to the point of this episode, when we think about the sellers, we're talking about, in some cases, just individual advisors or teams of advisors who ultimately launch an independent business and control, let's call it 200 million or up in fee-based assets. And it's not that you couldn't do some of this beneath that, but I think the math changes meaningfully and the market of potential buyers changes meaningfully for smaller firms. So for the focus of this episode, we're going to assume our sellers are $200 million fee-based businesses and up, mostly RIAs. We see some of these businesses coming from broker dealers, so firms like LPL, what was Commonwealth, Cambridge, Osaic, Cetera, and the like. But the reality is the independence and the open architecture feel of the RIA world, particularly as it relates to asset custody. So the idea that RIAs are allowed to custody assets with the third-party institutional custodian, it results in a much more unlimited pool of buyers and also a higher valuation. So the gold standard in this M&A world we're talking about as far as a seller goes would be a really quality, big fee-based, well-established RIA with a multi-generational team. That would be the best case scenario seller. As far as the buyers, I think there's a perception that private equity is the only buyer for these types of firms, and they certainly belong on the list. They are the big bad wolf, and there are a lot of private equity firms that are either in the space or looking to get in the space. But they're not the only buyer. Other RIAs are probably the most common buyers, right? Mergers or acquisitions with other firms in the same vertical that can recognize some synergies. Asset managers, traditional firms, brokerage firms. So there are many different types of both strategic and financial buyers, which, not to ruin the punchline, but I think that's why we take so much solace in this concept that if you build it, they will buy it, because we just see this real supply and demand imbalance. The idea that there are way more interested buyers than there are quality sellers.
Yeah. So, well, I want to come back to the notion of how do you know, without a crystal ball, how do you know that there will be buyers and who those buyers will be and what the valuation will be over time? But you made a comment. You said the PE firms, the big bad wolf. Are they always bad? And I'll address at what I mean. There are plenty of PE firms that have bought massive RIA firms and have really provided the capital, the infrastructure, the strategic input to take those RIAs from one that is not scaled to one that is tremendously scaled and have real value. And those firms then are able to turn around, and that's what gives them the ability to buy smaller independent firms. But tell me what you mean by big bad wolf. Why can or would a transaction selling to a PE firm, what's the buyer beware part of that?
Yeah, so it's a fair question. I said it a little tongue in cheek, not necessarily because that's what I believe, but because I think that's the perception in the industry. When we speak to advisors, generally that's the reaction. When you bring up private equity, it elicits a little bit of that like eye roll reaction. And here's why I think that is. First of all, the immediate risk or concern of private equity money is cost cutting or changes to the status quo. And that's the big bad wolf concept that some big private equity firm comes in and upsets the apple cart and says, we've got to slash expenses and cut margins and change leadership and blah, blah, blah. The other negative I'll give you, though, and this is one that we're seeing as a concern more and more today, is the idea that private equity's investment time horizon is short or relatively short. It's maybe 3 years, 5 years, 7 years, but it's not 20 years. And that makes people nervous when they think about affiliating with a firm or selling a portion of their firm to private equity, because they know there's a future disruption or another event down the line that they may not have control over. So, meaning private equity firm one has been invested in the firm now for 7 years. They want liquidity. They want to realize a gain on their stake. What are they going to do? Maybe they just sell to another private equity firm, or maybe they go further down the list of potential buyers I mentioned and they sell to UBS. And that's a less palatable outcome for many advisors who are at the firm. So this idea that you don't have control over the future sale or the future direction is becoming increasingly important. The reason I said I think it's increasingly important today is because we're probably in the fifth inning or so of this real move towards private equity backed RIAs. So meaning 5 to 7 years ago, many RIAs launched and took private equity money, which if you follow my logic means today, a lot of them are probably getting ready for some sort of transaction. Again, maybe that's an IPO, maybe that's a swap to another private equity sponsor, a sale to another strategic buyer. But I want to give one important caveat. I would actually argue that in some instances, a private equity firm is the best possible buyer. I'll give you an example of what I mean by this. This is a little bit of a tangential example, but Janney, which was a regional firm, a good quality regional firm, recently announced that they were selling to KKR. That is very much the example of a private equity firm buying into a wealth management firm. And the comment we made was, and I stand by this, I think is for the Janney advisors, this is the best case scenario. They're ultimately going to get a deep pocketed, smart, sophisticated investor who's probably not going to upset the apple cart too much because KKR is not in the business of running a wealth management firm. Contrast that with the potential buyer, right? UBS could have come in and bought Janney, and that would have been way more disruptive to Janney advisors. So I think PE maybe gets a little bit of a bad rep when sometimes they can actually be the most palatable and the most effective buyer.
I couldn't agree with you more. So let's go back then to that question around if you build an independent business, right this minute, I'm an advisor at a traditional firm and I am considering going independent, building my own firm. To follow your advice, one of the reasons I'm considering it is because I hope to build an enterprise and a legacy that I can ultimately monetize max dollar at day's end. And in order to do so, part of my plan is to sell it at some point on the open market. How do I know? How can I trust without a crystal ball that there will be interested buyers in that business when the time comes, say 5 to 7 to 10 years from now?
Well, you certainly can't. And this is where nobody has the crystal ball that you're talking about. And this is also, I think, speaks to even more why advisors will oftentimes default to these retire in place or sunset deals because they are the bird in the hand. Those you absolutely do have a defined, quote unquote, guaranteed outcome at the end of the day. But I take a great deal of comfort in two things as it relates to the concept of if you build it, will they buy it? Number one, there are so many interested buyers for these businesses. And it's just hard to imagine a world where that changes. It seems to be going the other way. There are more buyers who recognize every day how attractive and compelling a cash flow positive, stable wealth management business is. They're some of the best assets on the planet. So there have been so many interested buyers fighting tooth and nail to get into the space that I think just from a basic economic supply and demand perspective, that gives me comfort that this market will persist. The other, maybe more technical answer I'd give you to this is there's an idea of instant arbitrage that's available to buyers of these firms. And here's what I mean by that. Let's just say, Mindy, you run a $250 million fee-based RIA, and I'm a private equity firm that wants to buy your RIA. I can go in and purchase your RIA for some multiple of EBITDA, let's say it's 8x, because you're fairly small in the scheme of RIAs at 250 million in assets. What I'm going to do is I'm going to purchase you at 8x, and I'm going to roll up a whole bunch of other wealth management assets underneath my private equity firm. And then ultimately I'm going to sell that. But my now rolled up strategy is now managing 10 billion in assets. And my $10 billion wealth management firm is going to fetch a much, much higher multiple than your $250 million firm. So this idea that I can buy your wealth management business, and this is true, by the way, even more true for an existing RIA. I'm a big RIA, you're a small, buy you at 8x, and I can immediately sell you or put you into my entity and sell you for 12x. They'll take that trade all day long. And this is why we've seen so much consolidation in the space. If you want to play devil's advocate here, I think the one area where there is less certainty is on valuations and multiples. I think supply and demand solves for a lot of that. The idea that there's so much competition, which will keep valuations high. But there's no question that valuations have gotten frothy and they're sensitive to things like interest rates, market conditions, volatility. So is it possible that we see a slight pullback in multiples 5 years from now? Sure, it's possible. I think the more likely outcome is we see kind of stable multiples where firms are actually still willing to pay a premium for the top of the line, really quality businesses.
Yeah, I think that's actually the concept of immediate arbitrage is an exciting and interesting one. And I think that the notion of supply and demand really make it so that it's very unlikely that there wouldn't be a buyer for a high quality, growing, cash flow positive business. The question becomes, what about valuations? So let's put some numbers to it. Our listeners are entitled to it. We are recording this in the middle of April of 2025, in case somebody's listening a year from now. Talk to us about valuations. What do they look like now? And where do we think they're heading?
Yeah. So the first thing is for wirehouse or captive advisors, most independent firms are not valued at or purchased at a top line revenue multiple. I think you'll see more and more firms start to express deals for wirehouse advisors as a percentage of revenue because that's the language that wirehouse advisors speak. But unfortunately or fortunately, independent businesses are valued at a multiple of EBITDA or free cash flow. And effectively, here's what a buyer wants to figure out. They want to know, how profitable is your business going to be on our platform, not on your current platform, right? Post sale, where are you going to net out on my platform as the buyer? And then they'll also strip out advisor compensation because the thinking is, once I buy your business, I'm either going to have to pay you to service the book of business, or I'm going to have to pay somebody else to service the book of business. But regardless, they're going to strip that out from their kind of free cash flow concept. What that means, back of the envelope, most well-run independent businesses will have an EBITDA margin or an EBOC margin around 35 to 40% of top line. So if you're if you're a $10 million revenue business, in my example, that means an EBITDA or a free cash flow of right around $3.5 to $4 million. And that $3.5 to $4 million in my example is what the multiple will be applied to. Multiples scale up based on the size of the business. I would probably quote a pretty wide range of maybe 9 to 15x. My $10 million revenue business is probably somewhere in the middle of that range, 12 to 13x. So to put a number to it, if I've got $3.5 million of free cash flow to play with at a 12x multiple, that is a total valuation of $42 million at capital gains.
Okay, so a couple of things there. Number one is, how do I impact that valuation? So I break away, I go independent. Today, I've got a $10 million business, but what are the things I can do to make my business more attractive either today while I'm still captive or tomorrow when I go independent to make me more attractive to potential buyers?
So the easiest thing, or maybe the hardest thing, but the most impactful, is stickiness of products, believe it or not, are becoming a real hook for advisors because what they do is certain products have become very hard to move outside of the traditional firm world. I'll give 3 examples: alternative investments, especially proprietary feeder funds, SMAs and UMAs, and then those firm managed model portfolios, CIO type portfolios. Those are examples of very sticky products, and they're difficult to move out of a firm. And remember, there's usually that interim step of first, you need to move the business into an independent construct before selling it. So one thing is just make the book super clean and portable. The next thing is fee-based businesses absolutely fetch a premium relative to transactional businesses. That does not mean that a business needs to be 100% fee-based. We use the term RIA a lot, and I think people feel that means fee only. It doesn't. We're almost always talking about hybrids here, but we want to see, call it no more than 20% commissionable brokerage business and probably more like 10%. The more fee-based, the better. Next gen or Gen 2 and Gen 3 team members, not critical if you can find a quality buyer who can be the successor, but certainly having a successor built in that will make your clients stickier, will make you more attractive to a potential buyer. Time horizon is another one. And we spoke about this a little bit earlier. I think there's a sweet spot. A buyer probably doesn't want a seller who's going to hang around for 20 years, but also probably doesn't want a seller who's going to hit the ejector seat after 6 months, because again, then they'd be worried that the client relationships will be a flight risk. And then the last one, believe it or not, and we see this time and time again, we are not talking about Morgan Stanley recruiting advisors here where there are 19,000 or 17,000 people in the organization. We're oftentimes talking about pretty small, boutique, culture-centric places and firms. And so the personality and cultural fit matters. And we hear from firms all the time that they have no jerk policies, where they have literally walked away from potentially lucrative transactions because they just didn't feel like the advisor or the seller was the right fit for their firm. You have anything you'd add to that list?
No, I think you're absolutely right. Culture matters. And I think the biggest thing is to talk about the concept of begin with the end in mind. If you know that you are building a business that you ultimately are going to want to sell, then every decision you make needs to be made from the perspective of always doing what's right for client and what's right to grow the business and what's right for your staff. And I'm not suggesting it's not. But if you're ultimately building something to sell, then the notion is that you want to make decisions today that can positively impact tomorrow.
I love the concept of beginning with the end in mind. And I'm wondering, you've now been in this business now for close to 30 years. Is that a new concept, or is that something that you've been counseling on advisors for years? I guess what I'm trying to get at is this whole concept of building a business specifically for selling it, or at least in the back of your mind to be able to sell it. The idea that advisors are thinking about their business more as a business than ever before. Do you feel like that's new, or is that just something that's coming to the forefront because of all the private equity firms and interested buyers?
I love that question. And one of the privileges of having been at this for 30 years is I've had a front row seat to really watch how many things in the industry has changed. And that's not the subject of this episode. But the subject definitely is how advisor mindset has shifted. And the notion of advisors thinking of their business, as you just mentioned, and the notion of building the business with the end in mind certainly is a new one, certainly is something that an advisor 30, 50, 70 years ago might have thought about. But I'm not sure that they did. And I'm not sure that we know that the competition for well-run cash flow positive businesses certainly wasn't as robust. The waterfall of potential buyers wasn't as robust. And with less competition and less buyers, even if somebody did everything right and built the business with the end in mind and made the best decisions today in order to impact tomorrow, there's no way that valuations would have been as high or frothy, to use your word. There's no way that there would have been as many buyers. There's just no way as it would have been as robust.
I love that answer. So basically, what you're saying is it might have been true that people thought about their business as a business, but it just mattered less. Versus today, I think advisors look out at this expanded waterfall of possibilities. And by the way, it's a very lucrative waterfall. And they say, I need to be thinking about this as a business. I control an asset that's worth many millions of dollars. And there are so many different ways for me to go about. And we mentioned probably 4 different paths here in passing that an advisor can walk to recognize massive value from their business. I think the fact that there's so much competition and so much appetite has forced advisors to recognize, and it's a good thing, but has forced advisors to recognize, oh man, I control an asset that's really worth something and I should monetize this at day's end, or should at least be thinking.
Yeah. And the point I would make about that is the reason advisors didn't think about their business as a business is because if you ran a high quality business, for the most part, was to work for a traditional firm. The traditional firms were the number one culprit in making advisors believe, indoctrinating advisors to believe that the advisor wasn't an entrepreneur or a business owner. The advisor was an employee. And as an employee, the firm owned the business. And so as a result, advisors didn't think of their business as a business. But as the independent space really proliferated the industry and independence became more popular, and we started seeing more mainstream, best of the best advisors going independent and breaking away and talking about building enterprise value and all the things we've talked about today, the more it made advisors open their eyes, wake up and say, I'm controlling an asset that has real value that I'm able to monetize on day's end. I'm building a business with the end in mind. I control it, lots of different options, not one path. And that's a great thing.
Amen. I totally agree with that notion that advisors are the ones in the driver's seat. I think that's what's exciting. Even if this episode or this topic of M&A and launching an independent business is ultimately of no appeal, I think the fact that market exists is a very good thing, even for wirehouse advisors, because it's kept the traditional firms honest too. The traditional firms know they're competing not just against each other, but they're also competing against this concept. They know that advisors have the choice to launch an independent business and sell it. And so that has led to things like very aggressive retire in place and sunset deals, because these traditional firms too know they're competing against this. So long way of saying, while this might sound overwhelming and it might sound daunting, this is a very good thing. This idea that advisors have control, advisors have an incredibly valuable asset. And yes, I firmly believe if they build it, they will buy it.
So if you build it, they will buy it. I couldn't agree with you more. I think it's a catchy title for what's been a fun episode, an important episode. And at the end of the day, as you and I have been saying for a long time, it's a seller's market right now. The advisors are in the driver's seat. It's a great and exciting time to be an advisor. And we're going to keep talking about this so that everybody knows it.
Love it. Thanks for having me on, Mindy.
You bet. As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.